Hello, and welcome to P&L Tax Returns, General Ledgers, Oh My. Today we're going to give a simple explanation of each document. We will begin this discussion of the importance of financial information. As a managerial planning tool, financial information helps with the strategic planning and managing of the organization's finance to better align their financial status for their goals and objectives. Historical data helps tell the story of the organization. It allows you to analyze the business over time and assess the financial roadmap of the activities of the organization. It also allows you to forecast for the future direction of the business. And lastly, decisions. Decision making should always be based off of the financial information. And yes, I know it can be overwhelming, but this will help you in making effective decisions in your organization, creating budgets, understanding various perceptions, tracking efficiencies, analyzing product performance, and making long-term and short-term strategic moves within your organization. We're also going to talk about the importance of record keeping and how it can help with your taxes at the end of the year. Financial statements are powerful tools that you must use to manage your business. Financial statements play an important role in any business, no matter the size. The three basic financial statements that we are going to discuss are the balance sheet, the profit and loss statement, also known as the income statement, and the statement of cash flow. The firm's balance sheet reflects the operating profit. Because firms can make a profit from a variety of sources, it is important that you give an accurate picture of your company's success delivered through a particular product or service. The cash flow statement is going to show where a company receives its cash and how it spends it. Understand that the cash flow of a company changes rapidly as the business grows and flows. And the statement of cash flow reflects the changes from one statement to another. Revenue the company receives from the customer and from other places is also a part of the statement of cash flow, as well as outflows. So one of the things you want to consider as you analyze the financial statements is take into account the length of time you have been in business. And really think about the current economy in regards to your company's financial health. Assess your inventory levels, assess your resources that you have, and all of the different dynamics that may have an effect on your financial statements. These three financial statements should be in conformance with the generally accepted accounting principles, GAAP. And so this will allow for your statements to be comparable and also reduce misrepresentation. In thinking more about these financial statements, with the income statement, you want to ask yourself about profitability. How long to reach profitability, and did you make a profit or a loss? With the statement of cash flow, do I have enough to sustain and grow my organization? And with the balance sheet, what are my assets and liabilities, and how much are they worth? And so I'll dig into this further as we move on. Oftentimes, people ask themselves, do I really need to have an understanding of this? I have an accountant, I have a bookkeeper. Yes, the answer is yes. As you think about your organization and you think about ways to grow, you want to make sure that you have an understanding of your accounting cycle and the different transactions that go through your organization. You also want to make sure that you use this information for decision-making purposes when it comes to borrowing and also towards managing the business as well. The diagram on the screen just shows the process. It's just important that you think about these different elements when it comes to your business and be able to analyze them as they move throughout the accounting cycle. The first thing is to identify transactions. These transactions should be things that have economic impact on your business. So what does that mean? There's a dollar amount attached to it. Next, you want to record journal entries on your general journal, post your journal transactions, and this is done on the general ledger, calculate unadjusted trial balances, analyze your worksheets and identify any errors that you may have in your journal entries. You want to then fix those journal entries and create your financial statements before closing your books. Every accounting period needs to be closed before you can move into the next period. It's imperative that you keep this information up to date and accurate so that you can prepare yourself to close at the end of each accounting period and also be able to close at the end of the year. Moving into our financial statements. The first one is the balance sheet. The balance sheet represents the financial condition of the firm at a certain date. It details the items the firm owns, which is categorized as assets, and the amount the firm owes, which is categorized as liabilities. It also shows the net worth of the firm and its liquidity. The formula for the balance sheet is assets equal liability plus owner's equity. Again, assets is something that the firm owns. So this could be current assets such as cash, accounts receivable, inventory. It also can be fixed assets such as property and equipment and land. So these assets can be tangible, something you can put your hand on, and intangible, things like trademarks and intellectual property are also included in the asset category. Liabilities are claims creditors have against the firms. So this is things that the firm owe. This could be current and long-term liabilities. As a recap, the balance sheet recognizes assets equal liability plus owner's equity and basically shows the financial condition of a business at a certain date. As displayed is an example of the balance sheet. I will give you a full explanation of the balance sheet. I want you to first note that there are 3 sections: assets, liabilities, and owner's equity. At the beginning of the balance sheet, we see the asset category, and it's going to show current assets. Current assets consist of cash and other assets that are reasonably expected to be turned into cash, sold, or used up during a normal operating cycle. Next you'll see cash. It refers to coins, currency, and checks on hand. It also includes money that the business has in its checking and savings account. Accounts receivable is basically the claims of the business against its customers for unpaid balances for the sale of merchandise or the service performed. So basically, it's money owed to the organization for products sold or service rendered. You will then see a category labeled allowance for uncollectible account. So allowance for uncollectible account is subtracted as many organizations need to judge if accounts receivables will be uncollected. So as time goes on, there is an assumption that is made that customers will not pay after a given period of time, and therefore it becomes an offset of accounts receivable. Next is inventory. Inventory is merchandise held for resale to customers. Prepaid expenses are expenses that the firm has already paid and not yet used. An example of prepaid expenses is car insurance. So if you pay car insurance for 6 months, then that means that you have a prepaid expense that 1/6 of it is used each month until the 6 months have passed. Next is fixed assets, which consists of land, building, equipment, and other assets that remain in the possession of the firm for an extended period of time. Land is property used in the operation of the firm. Please keep in mind that land is the only fixed asset that does not depreciate. Building consists of the structure that house the business, and as we see, accumulated depreciation is on the balance sheet to write off the wear and tear over time on that structure. Equipment is next, and it is the machinery the business used to produce its goods, and again, we see accumulated depreciation. So we total our fixed assets, and then we have our total assets, which is the total of current assets plus total fixed assets. So moving into the next category is current liabilities. Current liabilities are obligations that will be due and payable during the next year or within the operating cycle. Accounts payable is the most common current liability. And this is the liability that incurs when goods or supplies are purchased on credit. Notes payable is a promissory note given as tangible recognition of a supplier's claim. Tax payable is liabilities owed to the government, whether federal, state, or local. And loans payable is the current installment of the long-term debt that must be paid within that current year. Long-term liabilities consist of obligations that will not become due for less than a year and is not within the current operating cycle. So most bank loans are long-term liabilities. Next, we see contributed capital. The contributed capital shows the individual who purchased stock, i.e. ownership, in the business. So the common stock is the most basic form of ownership. This ownership gives the individual the right to make decisions and or vote on decisions within the organization. Next, you see preferred stock and then retained earnings. Retained earnings are the accumulation of net income over the life of the business to date. So every year, this amount increases by the profit the firm makes and keeps within the organization. We see the total owner's equity represented there. And as you see, total liabilities and owner's equity are added together, and it equals the same as assets. So there is a balance. The balance sheet always balance, and that's what you want to keep in mind. Assets equal liabilities plus owner's equity.